Welcome to today's Explainer. Okay, today we are tackling something that usually makes people sweat just a little bit. Tax scrutiny. Specifically, we're diving into the Cbdt's fresh compulsory scrutiny guidelines for the financial year 2026 to 2027. Now, don't panic. We're going to break down exactly what the Income Tax Department is actually looking for and how the massive transition to the new Income Tax Act of 2026 is going to impact you.
Here is our game plan for today. First, we'll demystify scrutiny. Second, we'll hit the 6 specific scrutiny categories. Third, we'll compare the old versus the new IT Act. And finally, wrap up with some practical tax advice. All right, Section 1. Let's demystify what scrutiny actually means.
Look, before we get into the actual rules, we absolutely have to address the elephant in the room. I get this question constantly. Does a scrutiny notice mean the department thinks I'm evading taxes? Are they assuming I'm guilty? Let's just bust that myth right now. No, scrutiny absolutely does not mean tax evasion. Think of it more as a standard verification process. The department is literally just double-checking to make sure the information you filed actually matches up with their internal records. It's a review, not a conviction. Once you kind of internalize that, the whole process feels a whole lot less intimidating.
Moving right along to Section 2, the 6 compulsory scrutiny categories. Let's look at what actually triggers an automatic review.
So, category number 1 is CS01, survey cases. This kicks in if your business premises underwent a survey under Section 133A. The real trigger to pay attention to here is the timeline. If that survey happened anytime after April 1st, 2024, your return is automatically getting a detailed look. And it makes total sense, right? If they've already gone to the trouble of physically surveying your location recently, they're definitely going to want to cross-reference their physical findings with the actual numbers you filed.
Next up is CS02 search and requisition cases. You probably know these better as standard raid cases. If a taxpayer was subjected to a search under Section 132 or a requisition of books under 132A, again post-April 1st, 2024, they are absolutely locked in for compulsory scrutiny. Given the serious nature of a search or raid, there's just no way around it. It automatically triggers a comprehensive, deep dive review, no exceptions.
Category 3 is CS03, reassessment cases. Basically, the second you get a notice under Section 148, you're on the list. Whether that notice was sparked by a previous search, a survey, or really any other scenario where the department suspects income slipped through the cracks, your current return goes right under the microscope. The logic is pretty straightforward here. If they already have grounds to reopen your past records, they're definitely going to scrutinize your current ones by default.
Now, CS04 is a bit different. This one targets trusts and charitable institutions, and honestly, the rules here are super strict. If an organization tries to claim tax exemptions, but their registrations under Sections 12A, 12AB, or 1023C are canceled or invalid, that is a massive red flag. It draws immediate attention. Claiming a charity exemption without the active legal paperwork to back it up guarantees automatic scrutiny.
Okay, CS05. This one is actually a huge sigh of relief for a lot of folks. It deals with recurring additions from earlier years. So if you had income added in a past assessment and that exact same issue pops up again, it usually triggers a review. But here is the good news. The monetary limits just doubled. For major metro cities, we're talking Delhi, Mumbai, Bengaluru, you name it, the limit jumped from 25 lakh rupees all the way to 50 lakhs. And everywhere else, it went from 10 lakhs to 20 lakhs. Basically, this means smaller, recurring issues aren't going to drag you into a time-consuming scrutiny anymore. The final category is CS06, specific tax evasion information. Look, the tax department doesn't operate in a vacuum. If they get a tip-off, specific, actionable intel about evasion from external sources like law enforcement, intelligence agencies, or other regulators, your return goes straight to the top of the pile. An official tip from an enforcement body absolutely guarantees they're going to take a very, very close look at your filings. Now, you might be thinking, well, what about international transactions? That's a great question. There's actually an important exemption built into the process here. Cases involving international taxation and central charges totally bypass the standard National Faceless Assessment Center, or NAFAC. Because cross-border tax laws are incredibly complex, they get routed to a completely separate track handled by highly specialized assessing officers who actually have that specific expertise. Okay, I need you to circle this date on your calendar.
30 June 2026. This is the absolute hard deadline by which the Income Tax Department has to send out their Section 143.2 scrutiny notices for the FY 2025-26 returns. If your file got selected, you will officially know by that exact date.
All right, moving to Section 3. Let's talk about the old Act versus the new Act and how this whole transition works. With the huge shift to the Income Tax Act of 2026 coming up, pretty much everyone wants to know how the familiar 1961 rules actually translate into the new framework. Well, here is the exact legal mapping. The old reliable Section 139 for return of income, that becomes Section 263. That classic 143.2 scrutiny notice we literally just talked about, that's shifting to Section 271. Search and seizure moves to 247, and survey moves to 251. The big takeaway here isn't about memorizing all the new numbers, it's peace of mind. The section numbers are getting an upgrade, sure, but the underlying legal concepts and your protections, those stay exactly the same. Finally, Section 4. Let's jump into some practical advice.
So the theory is great, but how do we actually apply this day to day? Here is your quick 5-point survival guide. Number 1. Meticulously verify your AIS, Form 26AS, and TDS details. Make sure everything matches your return flawlessly. Number 2, do not hide high-value transactions. Report them completely and transparently. Number 3, if you had a past assessment issue, fix the root cause right now so it doesn't trigger that recurring C05 scrutiny we discussed. Number 4, if you run a trust, double and triple check your registration status before claiming any exemptions. And lastly, number 5, if you do actually get a notice, do not panic. Just respond calmly, on time, and with the proper supporting documents.
So I'll leave you with this final thought. With the 2026 transition right around the corner, are your financial records truly ready? The relief thresholds might be a bit higher now, but the expectation for flawless accuracy has literally never been stricter. Take some time this week to review your compliance, check those forms, and get organized. Thanks so much for joining me for this explainer, and we'll see you next time as we keep navigating the future of tax law.